Good morning, sir. Good morning, everyone. So, I am the continuations of the report. So, in 2021, Mr. Wang Lu, an NRA NetP, was hired by Rahman Company, a domestic manufacturer, to install his inventions in RHC's factory. RHC pays him royalties and the installation fees. Mr. Lu also agreed to design RHC's website, which he designed and completed abroad. During Mr. Lu's visit, he purchased shares of RHMC and subsequently sold them directly to a buyer. Mr. Wang Lu is a foreigner, was hired by Rahman Company in the Philippines to install his invention, to receive royalties, to develop a website, and buy and sell shares in the Philippine company. This for inventions is at 300,000 pesos, installation phase 1 million, website development phase 500,000, gain on sale of domestic stock directly to a buyer 40,000. So, Ruhumahon Company shall withhold the following final taxes. So, the royalties from inventions is 300,000 and the professional fees is a 1 million. So, they add 300,000 to plus 1 million, total of 1,300 pesos, the total gross income. 1,300,000 pesos, they multiply by the final tax on NRA net B of 25%. So the total final withholding tax is equivalent of 325,000 pesos. The next is the tax sparing rule. So NRFS shall be subject to a 15% final tax on dividend income instead of the 25% general final tax. In the country of domicile of the NRFC's credits against the tax due of such NRFC's taxes presumed to have been paid by such NRFCs from the Philippines equivalent to 10% of the dividend. In applying the tax sparing rule, the Supreme Court ruled that the NIRC does not require that the foreign law of the non-resident corporations must give a them paid tax credit for the dividend equivalent to the percentage points waived by the Philippines, pointing that the NIRC merely required the country of the NRFC to add them paid tax equivalent to that waived the Philippines. So, the requirement of the tax sparing rule is deemed satisfied if the country to which the NRFC is domiciled imposes on tax on dividend from foreign sources, or BIR rolling numbers 104 to 2012, March 22, 2012. If a foreign corporation receives dividends from the Philippines, the usual tax is 25%. But if the foreign country credits or reduce the foreign tax by at least 10%, the Philippines only charges 15%. So this prevents double taxation and encourages foreign investment. The tax sparing rule with NRFCs or non-resident foreign corporations is due to receive a dividend of 1 million pesos from a domestic corporation. So the final tax to be imposed by the Philippines, which shall be withheld by the domestic corporation, shall be 15%, not 25%, if the country of domicile of the NRFC also reduce its income tax upon the 1 million pesos dividend by at least 10%, the dividend tax percentage waived by the Philippines from the 25% general final tax rate. If the country of the NRFC does not reduce its tax on a dividend by at least 10%, of the Philippines shall impose the 20% final tax. When a foreign computations of NRFC receive dividends from a Philippine company, the standard tax rate is 25%. But if the foreign country provides a tax credit of at least 10% to the NRFC, the Philippine tax is reduced to 15%. This is called tax sparring. For an example, an NRFC received 1 million pesos in a dividend from the Philippines, so the Philippine tax should be 25%, so equals of 250,000 pesos. However, if the NRFC's home country gave us a 10% tax credit in the Philippines, the Philippines imposes only 15%, so equivalent of 150,000 pesos. So, to avoid double taxations and attract foreign investment, so there are legal bases of BIR ruling number 104, 2012, and Supreme Court rulings. Other final income taxes. Fringe benefits of managerial or supervisory employees, income payments of resident other than depository banks under the expanded foreign currency deposit system or AFCDS and expanded foreign currency deposit units AFCUS. Number 3 is income payments to oil explorations, service contractors or subcontractors. Number 1 is the fringe benefit tax. Tax on extra employee benefits like company cars, housing, or etc., especially for managers and supervisors. For the income payments, so interest on foreign currency deposit is a residence exempt banks pay 10% final tax on interest earned from the foreign currency deposit units. And number 3 is payments of petroleum subcontractors. Contractors working in petroleum services pay a final 8% tax on their income from the contracts in the Philippines. On special aliens. Under the old law, employees of offshore banking units, regional operations, or regional administrative headquarters of multinational companies, referred to as special aliens, are previously subject to 15% final tax on gross compensations income. The special alien classification is now abolished by virtue of presidential veto to the train law. As such, these employees are not subject to regular income tax if they are resident and 25% final tax if they are non-resident. For these, special aliens, employees of offshore banking units or regional headquarters of multinational companies, under the old law, they were subject to a 15% final tax on gross compensation income. However, this classification has been abolished due to a presidential veto of the train law. Now, these employees are subject to regular income tax if they are resident and a 25% final tax if they are non-resident. Final withholding tax return. The final withholding tax return, BIR Form 0619F, monthly remittance return of final income taxes withheld, shall be filled in triplicate by every withholding agent or payer who is either an individual or corporation for the first 2 months of the quarter. So this section details the requirements for filling the final withholding tax return, also known as the monthly remittance return of the final income taxes withheld, must be held in a triplicate by every withholding agent or payer, individual or corporations for the first 2 months of each quarter. Deadline applies for monthly manual filing. The return shall be filed and the tax shall be paid or before the 10th day of the month following the month in the which holding deadline applies for monthly manual filing. The return shall be filed and the tax shall be paid or before the 10th day of the month following the month in which withholding was made with. A is the authorized agent bank, the revenue district office, having jurisdictions over the withholding agent's place of business. So, of these, dapat the authorized agent bank or the revenue district office with jurisdiction. B is in places where there are no authorized agent banks to the revenue collections officer. For the revenue collection officer, if no authorized agent banks are present. C is the authorized city or municipality treasurer within the revenue district where the withholding agent place of business is located. Dapat naka-authorized city or nakakuan po sila sa mga municipality treasurers within the revenue district. Monthly deadline for AFPS filing. In accordance with the schedule set forth in RR number 26 to 2002, the deadline for a filing of returns is as follows. For the Group A is a 15 days following the end of the month. For the Group B is a 14 days following the end of the month. For the Group C is a 13 days following the end of the month. For the Group D, 12 days following the end of the month. For the Group A is 11 days following the end of the month. Quarterly filing. With the withholding agent shall file BIR Form 1601 FQ, quarterly remittance return of final income taxes withheld on or before the last day of the month after each quarter. So, dapat ang withholding agents must file og BIR Form of 1601 of FQ. So, muna mo'y quarterly remittance return of final income tax withheld by the last day of the month following each quarter. So, this is an addition to the monthly filing previously discussed. Discussed ni siya. Penalties for late filing or remittance of final income tax withheld. The same penalties for late payment of income taxes as discussed in Chapter 4 apply for non-withholding or non-remittance of final taxes. So, these penalties for late filing or remittance of final income taxes are the same as those for late payments of regular income taxes. Entities exempt from final income tax. So, number 1 is the foreign governments and foreign government-owned and controlled corporation. For the government, foreign and the foreign government-owned corporations, exemptions is based on principles of international committee or mutual respect between nations. Next is international mission organization with tax immunity. So, similar to the above, this exemption stems from international agreements and diplomatic relations. Number 3 is general professional partnership. These are explicitly exempt from income tax under the National Internal Revenue Code or NIRC. Number 4 is qualified employee trust fund. For this, also explicitly exempt from the income tax under NIRC. So, the exemptions applies not only to the final income tax but also to the capital gains and regular income tax for the first two categories listed. And that's all my report. Thank you.